All right, everybody, welcome to FMC with your host, Tony, the head of FinancialJuice, and of course, running this service here for you with MACROACE. So let's go through it. We've got about less than an hour now till we get the FMC rate decision, where the central bank is expected to deliver a 25 basis point hike, but hopefully everyone can hear me clearly and also see the screen clearly. So let's get into it straight away. So what is FMC and what is it all about? So the Fed members or the Fed Bank presidents, what they do is they meet roughly every 6 weeks over 2 days to discuss monetary policy and set the Fed funds target rate. Then it is also the rate that banks charge each other to borrow or lend excess reserves overnight. Following on from that, why is it important? What are the key things to be aware of? Well, of course, the obvious reason is that it causes a lot of volatile moves within the markets, and it may influence other central banks to follow in the rate path. Or what it can mean is, when I talk about following the rate path, I mean either following the central bank, the Fed's hiking aggressiveness, or vice versa. So we've seen that a lot with the other central banks in the past when we've had the data from the Fed, particularly in the height of the Fed's tightening cycle. We've had the UAE, the Saudi central banks that have decided to raise their rates as soon as the rate comes out from the Federal Reserve, or not too long after. Now, carrying on, so how does it affect the markets? Very easy to understand. It's if you have a currency, whenever you have whenever you raise the interest rate on that in that nation, the currency usually appreciates, because that will attract international investors and also traders to invest into a currency that will give them a higher rate of return with the interest rate. So particularly for bond traders as well. Again, that's also quite key for them, is which currency, which interest rate is going to give them the best rate of return when they invest in bonds internationally. Then for the stock market, again, easy. If you raise rates, you expect the depreciation in the stock market. Of course, you're increasing borrowing costs for not only consumers but also businesses too. So there's less availability of credit that happens with the tightening of credit that happens with commercial banks and consumers and also businesses as well. Then for the bond market, so there's two things to be aware of with the bond market. Of course, you have the bond yield that reacts positively when rates are raised. Of course, there is the anticipation that central bank may continue raising their rates for longer, or is in their tightening hiking cycle path. The other thing to consider with bond yields rising as well is that the short-term rates, such as the 3-month, 6-month bill auctions and the 2-year note, they are affected quite a bit. Particularly the 2-year note is, of course, the shorter term rates that you look at. You will realize that they have an affinity to be affected by the central bank's tightening rate a lot more than the longer term rates, like the 30-year bond. The reason being is that's where all the action happens, and that's where the Federal Reserve has the most impact whenever they raise or cut rates or keep their rates unchanged. And it's also used as a way, as I said earlier on, as a way for forward guidance too for the markets when they're pricing in their rate expectations. Not only do you see a reaction within the bond market, but you also see the rate expectations speculation for future rate hikes or cuts in currencies and stocks as well. So you get that extra amount of volatility that comes into the market that we've got to be aware of. That yes, there is that short-term reaction, but then what happens after that is usually the markets kind of peel off, and then once they've priced in what they expect or where they expect the Federal Reserve to go next, then that kind of volatility peels off and then goes back to normal. And we've seen that over the last, not only with the rate decisions, but also the inflation figures as well in the past. Although I will say, with the inflation figures that we've had in the past, they have, when there has been good data or bad data, you might have a reaction that lasts for at least a couple of days for the within the markets, because of how significant those economic releases are and those economic indicators are. So that's also another thing to be aware of, is how long does the market kind of sustain the initial reaction. But another thing, so we're going back to the bonds, whenever you raise interest rates, and as I said, the bond yields usually go up. On the flip side, bond prices go down. So how it works, if you're not sure how bonds work, the government provides an amount of debt, and they say, hey, if you invest in this amount of debt for, let's say, 5 years, we'll give you this rate of return at this price. Usually when the economy is doing well and rates are being raised, the yield on those bonds go higher and the price of those bonds start to go lower. However, if there is fear that creeps in, or if there's a bit of a risk-off reaction that creeps into the markets, what can happen is that those traders who would usually go for risky assets like stocks or exotic currencies or junk bonds, corporate junk bonds, then they start to pile their money into safe havens instead. And one of those is within government bonds. So what actually can happen is bond prices start to go higher as there's more demand, and the yield or return starts to go lower. Of course, the government isn't going to pay out a bond with a high rate of return for a cheap price if the economy is not doing well. That doesn't make sense. So there's a bit of there is regulation within the bond market there. So there are many ways to kind of view the bond market, and when you're looking at when you do have an interest rate decision, how will it affect the bonds and the other markets in that time, and then what is a future reaction, what is expected of it, what kind of reaction is expected of it in the future. Hello everybody, hi Yusuf, hello, no worries, thank you for joining. Kareem says hey as well, hello to you. Lee, hey, evening again, hello. Hey Will, good to see you again. Ralio says, so if rate is raised, the market crashes. Well, my friend, that's what we'll kind of discuss. There were expectations. There's what's already priced in, and then there is the point of what's not priced in. Okay, if there is there a surprise with the rate decision? That's what we'll go over in a bit more detail. But let's go through where the economy is at the moment. Okay, so GDP at 2% for the first quarter. Oh, bear in mind, we're going to get Q2 data tomorrow. That's after the ECB rate decision at 8:15 a.m. Eastern Time. GDP data for Q2, advanced data, will come out at 8:30 a.m. Eastern Time. So that's something we're going to cover in part with the ECB rate decision. Not really a lot to kind of cover off with it, but it's going to be quite key as it has had volatility, quite a bit of volatility in the past with the advanced data particularly. Inflation at 3% compared to 4%. PC price index at 3.8% compared to 4.3%. The consumer spending data at 1% compared to 6%. Non-farm payrolls was at 209k compared to 339k. ISM manufacturing PMI data at 46 compared to 46.9. Services PMI 53.9 compared to 50.3. So remember with the PMI data, whether it be the ISM data or the HCOB data, or you can refer to it as the original market market PMI data, a figure above 50 usually denotes that that area of the economy is in expansion. Below 50 shows contraction. If you go past 47.1 is what economists say, that's when that part of the economy is in recessionary mode or seeing a lot of trouble, which would become a cause of concern for not only the government and those businesses within the area, but also the Federal Reserve too. Of course, they might be thinking that maybe they've over-tightened. So there's also that fear as well to be aware of when you're looking at the PMI data. Michigan sentiment was at 72.6 compared to 64.4. The 1-year inflation expectations was at 3.4 compared to 3.3. 5-year inflation at 3.1 compared to 3%. Unemployment cost at 1.2% compared to 1%. Now, why am I showing all these economic indicators? The reason being is this is what the Federal Reserve would be looking at overall in their judgment of where the economy is in their eyes. They've said that they're going to be data dependent, and these economic indicators, or most of these economic indicators, is what they would be focused on. First of all, where is inflation? How is productivity within the US? Is consumer spending being hampered, or is there consumer spending being hampered by the Federal Reserve's rate hikes, and there is a less demand for goods and services because there is less money that is credit that is available within the economy? And then how is the manufacturing sector and services sector doing within the US economy? Is there a bit of faltering that is occurring? And then the expectations for inflation too. What do consumers see where they expect inflation to be? Because of course, the University of Michigan sentiment inflation expectation results have had and still do have an effect on how the markets will react. If you do get a higher than expected figure for the inflation expectation data, then usually that you get a bearish reaction from the stock market and the dollar appreciates because of the expectation that the Fed might have to do more work. Okay, the previous FOMC. So actually one thing I want to kind of go through. So the overall data, so what it kind of means for the economy then, is that the data indicates a more, let's say, nuanced situation. So while there are positive signs, such as improving consumer sentiment and expansion in the services sector, declining inflation, there are also challenges too. So of course, slower job growth and contracting manufacturing sector. So what does this mean for the Fed? So inflation helps the case for a less aggressive action, all right, because that's the Fed's main goal, to bring inflation down and then kind of deal with everything else afterwards. So the previous FOMC, I want to give a summary of what they had said in their statement last time around. So economic activity, they indicated that economic activity has been expanding at a modest pace and job gains have been strong and the unemployment rate remains low. With inflation, they've said that remains elevated, which means that prices for goods and services are increasing at a higher rate than desired. And then what does that mean? So what does it mean to the Federal Reserve? So the statement, what it's simply doing is acknowledging the elevated inflation and demonstrates the Fed's commitment to addressing it. But also shows that the central bank is being proactive in dealing with potential risks to price stability. One of the other things that I wanted to mention as well before we carry on is what is the difference between the June meeting and the May meeting? So the only difference, and when I talk about that, what is the difference in the statements? The only difference being is that there was a rate hike of 25 basis point hike of a 25 basis point hike in the May meeting, and there was no change in the June meeting. So everything else was the same. It was just that they included that they raised rates in the May meeting compared to the June meeting. So the Federal Reserve, again, to summarize what they said, is they're still being data dependent. How what are the lags and the effects of their rate hiking cycle has on the economy. Then if we look at the Fed SEP, or the summary of economic projections, what we had last time around, this is what, if you can see the bottom red box that I've highlighted with the federal funds target rate, or the federal funds rate and where they expect it to be, that's what rocked the markets last time round when we had the SEP, where the expectation for where they see the federal funds target rate had jumped up to 5.6%, or let's say 5.75%. Okay, realistically. So this is one thing to be aware of, is that there is a need to continue raising interest rates from the Federal Reserve in order to try and bring down inflation. And the reason why they have upgraded their expectation for the federal funds target rate is because where they see the core inflation. That's what they've cited as being the key issue when trying to bring down inflation. It's a core data, not just for PCE or the personal consumption expenditure index. It's also in referencing, not explicitly, the CPI data too. So if they expect core data to be stickier in the PC side. They're also expecting that to be stickier in the CPI side, which is still the main release that gets a lot of attention in this hiking cycle, besides the interest rate and non-farm payrolls. So they've upgraded their expectations. And what does that mean? So overall for the SEP, so the projections, it shows a modest economic growth outlook with the expectation of a slightly high inflation and gradual tightening of monetary policy through higher interest rates. So what kind of approach is the Fed expected to take then? So these projections, what it could suggest is a cautious approach with gradual economic expansion and potential interest rate increases in the near future. And that could mean a slow build or a slow incremental increase in the Fed's target Fed funds rate instead. And we've seen that they've taken they took a 25 basis point hike in the May meeting, but also upgraded their expectations for rates in the June meeting. So we're not really out of the woods yet. So from the Fed minutes, some participants indicated they favored or could have supported raising the target rate by 25 basis points. Fed staff saw a mild recession as likely to start later this year, same as in the May minutes. All participants agreed maintaining a restrictive stance would be appropriate. And then if we kind of summarize what that means overall, it suggests that there is a cautious and somewhat divided view among participants, right, in regards to the appropriate monetary policy actions. So some participants being in favor of raising interest rates, while there is a consensus among all participants to maintain a restrictive stance. But it depends on whether you stay at the rate that you are at now, or whether you continue raising rates to become even more restrictive with your interest rate decision. Fed members then, what do we got from Fed Powell? Powell said on the 29th of June that we haven't taken consecutive moves off the table. The risk of overdoing tightening isn't balanced yet. Mester said that I would have hiked rates in June, but I understand why the Fed didn't act. Kashkari and Barkin, first from Kashkari, said that entrenched inflation could prompt the Fed to hike further, and inflation is still too high. And then July 13th, you had Fed's Wallace said that the Fed is most likely to require two more 25 basis point rate hikes this year, and employment and economic momentum give the Fed room to hike further. So first of all, going off of the last point that Fed's Waller made, if jobs data and economic momentum or productivity within the US continues to remain strong, and you don't go into the, let's say for GDP, particularly for GDP in the minus figures, then the Fed has more room to do what they need to do. That they believe that the economy can handle the rate hikes that they're doing at the moment now. It doesn't mean that they're going to go super crazy and continue hammering the economy with multiple amounts of continuous amounts of rate hikes throughout the year. I hope they don't, because then that'll really distort what the Fed's path is and where they want to end up. But it just means that they're confident in their rate hiking path, that the incremental steps that they're taking are not doing a lot of damage yet. Of course, usually it takes about a year to 18 months for interest rate decisions to have an impact on the economy. So far, we've already gone past a year or so with the Fed's rate hiking path, and things have been okay so far within the USA. Inflation is coming down and job figures have been robust. So it does, although there is the caution of how the manufacturing sector has been affected, and how consumer spending might have dropped off a little bit in the data. There are tighter credit conditions. Wow, I sound like Fed's Powell. How about I replace him on the podium today? I couldn't do that. There's too much pressure and politicking. I'm not interested in doing that. I don't want to bust my brain for anyone. Let's get back to it. Now, this was the summary, or this is the CME Fed Watch tool that hopefully you guys should be aware of, but it just shows what is the expectation of where the interest rates or what action the Federal Reserve will take in their upcoming meetings. So the last time I had taken a snapshot of this picture here, of the say the bar chart, last time round, there was majority, or more or less nearly 100%, were expecting a 25 basis point hike to 5.5%, but there was still a small margin of people that were expecting no change from the Federal Reserve. Of course, if you find this, just to kind of cut things off a little bit here, and go to a different point, if you find this information useful, don't forget to share it with your fellow traders and friends. Get the word out there if you feel that this is good information. Do you guys find this information useful so far? Let me know if you don't. But the volume is quite low. You should be able to. Can you hear me? Hopefully that should be a little bit better. I might have done it with a sensitive mic. Yeah, there we go. That's louder. Yeah, just waiting for it to play back and hear myself. But yeah, Legend said very useful. It's a good refresher, says Will. Austin says it's all good. I think you might be talking about the sound, but maybe you was talking about the preparation. User said very useful. Benjamin said the volume was perfect. Maybe the other person needs to just turn their volume up then, so it will be super loud. All right, let's carry on then. We've got more or less than we got more than just over 30 minutes till we get the Fed rate decision. Arshad says hello, good knowledge. Okay. Yeah. No, it's a new little system that we've kind of got running with it. So just kind of seeing, well, it is a better mic. So there are some things to kind of work out with it. But yes, I will make sure in the future. But so going back to this, so there's a small smidge, okay, that of 1.1% that is expecting a 50 base point hike. Albeit that is small. How could you interpret this? Okay, the 1.1% expectation for a 50 base point hike at this meeting. Here's how I would interpret it: is that there is the expectation for more hikes, another hike at the next meeting, rather than the expectation for a 50 base point hike. That's logical, right? It makes more sense rather than expecting a 50 at this meeting with the Federal Reserve, but expecting another 25 base point hike at the next meeting. That's how I kind of see it from that point of view. So basically, don't get confused with thinking that there is going to be a 50 base point hike, or there may be. Keep it in the back of your mind, but kind of think of it as that there is more tightening that the Federal Reserve will need to do. As I did switch from a pause on the left-hand side and the expectation for a 25 base point hike at nearly 100% to 99% for a 25 base point hike and 1.1% expectation for a 50 base point hike. But yeah, so just one of the things to kind of be aware of what markets are feeling at the moment. What is the current sentiment surrounding the markets at the moment? So investment bank and economists and sentiment views. So JP Morgan, they said it's going to be hard to get enough demand compression without a recession to get price pressure out of the system, according to their chief economist, Kasman. That they added, I don't think inflation is going to slide below 3% on a sustained basis, i.e. there's going to be little chops here and there. But the risk from the Fed is it is the Fed raising rates again after this week, especially if the US doesn't slip into a recession later this year. But JP Morgan overall still expects July will be the last hike. On July 24th, so Goldman Sachs, they said that their economists at Goldman Sachs sketched a more optimistic outlook compared to others and downgraded the likelihood of a recession to just 20% from 25%. Hatzius, one of their economists, noted that the main reason was recent data reinforced their confidence that bringing inflation down to an acceptable level won't require a recession. And they also said the next expected rate hike will probably mark the last in a string of hikes that began last year. So again, the expectation for this to be the last rate hike from the Federal Reserve. Although, as said, according to the CME FedWatch tool, there is still the risk that they might do another rate hike. Deutsche Bank said that they were among the first banks. So Deutsche Bank, of course, if you remember, they were among the first banks to forecast a recession, but have been encouraged by the economy's direction. Although they still expect a downturn later, and they said that we have greater resilience in the economy at this point in time, given the extent of rate hikes we've received so far. So the other thing is that you can't really rule out a recession either. So overall, from these comments, or a mix of these comments, Fed hikes have, of course, made the cost of buying a home, financing a car, or expanding business much more burdensome. So it's only a matter of time until there are more indicators that kind of flash red lights at not only the Federal Reserve, but also the government too, as to where other areas in the economy start to have a shortfall. Maybe in productivity. Maybe in consumer spending. It could also be, particularly, let's say, in the services side of the US economy, if the ISM services data or PMI services data starts to falter and fall off, then you've got two ways of monitoring the US economy via the manufacturing PMIs and the services PMIs that are kind of stuck in contraction territory. Okay, let's look at market pricing as well. So June 29th, so post better than expected GDP data. Fed swaps saw a 50% chance of a second rate hike by the year end. July 12th, lower CPI data. Fed swaps priced in lower odds of a second rate hike this year. And July 20th, post stronger initial jobless claims data. Fed swaps price in higher odds of another hike after July. July 25th, Fed swaps resume pricing in 50% of odds of a post-July rate hike as well. Okay, let's have a look at the last economic release that we had for the data from the FOMC, and then what we'll do is we'll go through the deviations as well, and the deviation sheet, which hopefully guys should now have full access to, i.e. you should be able to look at all the different tabs. Remember, if you are looking at the deviations sheet, of course, there will be economic releases that aren't updated because the market reactions have been too weak, or there hasn't been a market reaction at all to kind of note. So if you, let's say if you have, do have access to that and you think, where's all the other data? Well, again, it's focusing on the data. It's focusing on the data that has a market reaction or has had a significant market reaction, at least within the markets. So let's carry on. So what I'm going to do now is going to show you the last market reaction that we had here for the FOMC. Of course, remember you had the rate decision paired with the SEP and rate statement as well at the same time. But this is about 10 seconds before the last release that we had. We've got the dollar yen, gold, and the S&P on the bottom left. All right. So we kind of play it. I'll just let you guys watch it. Okay, so the rate came in as expected. The dollar climbed, right? And if we look at the deviations sheet, if you did subscribe to the mailing list, you should have access to it. If you go to the FOMC rate decision, what I've done is I've kind of tabbed it with a red color, so you know what the current releases that we're covering are. So what was the sentiment then? Why did the dollar fly up? Okay, and why did the S&P collapse? If the rate came in as expected, if it was already priced in. So this is one of the risks that you have to be aware of. Interest rates are not simple. A figure comes out and you trade it one way and then you hope then the market goes in your direction. No. Or even if you go in the other direction, if it's the right way, you might be hammered anyway. But what I mean is, there are other factors that you have to be aware of with rate decisions. Just like the jobs report, you have a multiple amount of releases at the same time that could shift the sentiment into a different direction, even if the headline figure is positive or negative. What happened here, okay, it was the Fed officials, as you can see there, that had seen the Fed funds rate at a median of 5.6% at the end of 2023 compared to 5.1% in the summary of economic projections. So that's what caused the markets to sell off, i.e., there is more tightening that is expected from the Federal Reserve. They're not done yet, so there's going to be a bit more pain for the stock market and a bit more love given to the dollar instead. Hence, you get this market reaction here. So when we're looking at the rate decision and we're talking about what to look out for, what to be aware of for the risks that come with the rate decision, first of all, you have the figure that itself. Okay, if the Fed raises by higher than expected amount or raises rates when they weren't expected to raise rates or cut and vice versa, that brings in volatility. Traders price in where they expect the rate to, what they expect the rate to be within the markets. Okay, if you do expect a 25 basis point hike, then the S&P and the stock market would see some downside movement and then kind of work its way back up. But whenever there is a surprise, then there is more volatility. We know that, and you guys should know that as day traders, the more volatility that there is, the bigger the moves that there are that occur. And the bigger the surprise, should I say, the bigger the moves that occur within the markets because of the panic that occurs within the markets. Okay, things didn't go their way as expected, so they've got to take action or jump on the action that they see within the markets to capitalize it or manage their risk instead. Okay, just one of the couple of the things that traders would do. But if you are, I don't know who else is looking at the deviation sheet at the moment. If you guys, do you guys use the deviation sheet? I have made it as something that you can see in live real time yourselves rather than like a PDF screenshot, PDF version of or static version of the deviation sheet. Do you guys still use the deviations? Google sheet that I've shared with you. If you don't, tell me why. Because in the past, this is actually a question I've wanted to ask in the past before. Is if you've asked for it in the past, and again, it's completely free. There is no charge to it. You can hop onto it and look at everything that you want to look at. Completely free. But I want to kind of gauge for those of you who had subscribe to the mailing list, if you do use it, and if you don't, why not? So if you let me know in the comments what your thoughts are, or maybe why you don't use it, or if you do use it, if it works, if it doesn't work, that'd be really useful for me to kind of understand, engage, and then provide you better content as well. So, as I said, let's go through the deviations and the individual market reactions. But as said, we have to be aware of not only where the figure comes in at. If it's higher than expected, let's say they do go with a 50 basis point hike, then you would expect a lot of strengthening from the dollar because the expectation is for a 25 basis point hike. That's what traders are expecting. The unexpected is a 50 basis point hike instead. Let's pause that. Let's get out of that. Let's go to our markets here. And then you've also got to look at the rate statement itself. The rate statement itself is also very key. You could have a rate hike, but then a dovish statement from the central bank, i.e., they present a weaker than expected prediction where they see the economy, and maybe that this is more of a dovish hike. Or they could have a really hawkish statement paired with a hawkish reaction or hawkish decision, where they see the economy is still doing well, or they still cite that inflation is a problem that they need to bring down, and it's stronger than they would have expected it to be, and that could again provide some significant upside movement to the dollar, and then really crush the S&P 500. Oval says I didn't know about it. I am new to it. That's perfectly fine. What you can do is, so if I just bring up the deviation sheet here we go. This is the deviation sheet. Okay, what the deviation is, it tells you how the markets react to an economic release or an event, how big the market reaction is, and particularly for the interest rate decisions, what is the sentiment at that time as well. So you can look at, of course, not only the FMC, Bank of Canada, Bank of England, ECB, which we have tomorrow in the morning Eastern time at 8:15 for Eastern time. We'll be doing a live stream 30 minutes beforehand at 7:45 a.m. Eastern time for a bit of prep. But you can see those different economic releases. Some of the releases aren't updated because either, as I said in the past, as I said earlier on, the reactions have been minimal, small, or not really worth looking at all. So you will see that some of the sheets don't have an updated market reaction because of that reason. I'll still watch it and see what happens. It's not like I'm saying I'm putting it off altogether. It's just that recently it's not been enough to kind of garner my attention. Say, okay, let's continue covering it. Joe says I'm subscribed to the deviation sheet. Helps me set expectations for how an event normally moves an asset. Good. That's yes, Benjamin. I'm talking about the deviations and ranges sheet. Maybe someone could post a link to I'll put it in here for you guys. Here you go. Hold on. Let me see what I got. Hold on. Let me grab it for you. Give me 1 second. Right, actually, here we go. I don't have it with me now. But what you can do is you can subscribe to the MACROACE mailing list. Here we go. That's there. The MACROACE mailing list, what it basically is you get one email every Monday in the morning giving you an expectation for the different sessions ahead for the week for Asia, Europe, and the US, and the deviations for the link to the deviations for the economic release as well. So if you sign up to that, you get it there. And again, that's completely free. There's no payment that is needed, no subscription, paid subscription, completely free. You just sign up to it and you get the link for the deviations, not only of course for the upcoming economic releases, but all of them, all there in one Google Sheet that you should be able to see and have a look at. Bearing in mind, in the email, there isn't a lot that's kind of put together, compiled together with the text, because I go through the detail of the economic releases with you here in these live streams that I do. Whoa, whoa. Did you not receive an email? Oh no. You might want to check your spam if that's the case. It should have come through. Jonathan Aloni says, thanks a lot for the preparation. Can you please show how the NQ have reacted in the past? Yeah, we're going to do that now. That's what we're going to do. So this is what you can do, right? Kind of chop and change what you're looking at. But yeah, here we go. So this is very key. And we'll cover all of the different asset classes. But if we look at the indexes, the stock indexes, so you can see that when the rate was raised as expected, but the sentiment was that that there is more tightening that is needed, then you had a negative reaction from the stock indexes. Okay, so if we're looking at the NQ, initially, Okay, there was 237 ticks towards the downside on the 1 minute candle and on the first candle, going to the wick of the candle. Okay, because I like to capture the whole movement. And then 10 minutes after the release, that's what the brackets, the figure in the bracket shows here, is the movement 10 minutes after the release going to the end of the candle. Okay, so you can see that even after 10 minutes, that the NQ was still down by, let's say, nearly double the initial market reaction, or not nearly double, but getting to it. On the S&P or the ES, you had seen 50 ticks down initially, and after about 10 minutes of trading, though, it was down by 81 ticks. On the Dow, on the YM, it was down 75, and then after about 10 minutes of trading, it was down 176 ticks. So what do we kind of look at in the FX market is also quite key too. What's the biggest mover that we've seen overall? It's been the dollar yen. And the reason why it's been the dollar yen in the past is because Japan has been very relaxed, or has continued their monetary easing for so long, that all these other central banks like the Bank of England, the ECB, Bank of Canada, RBA, RBNZ, have more or less, they're getting close to where they want to be with their interest rate, or their main rate. So there, of course, there are different issues that Japan faces. But again, remember, traders, what they will do is whenever rates are raised, they will go to that currency, which will give them a high rate of return whenever you're investing in the bond market as well. And there's more of an attractiveness too, as well, to that currency. Of course, there is a carry trade with the yen. Whenever you're taking out a loan, it's best to get it in a currency way, in a country where you have super low interest rates. And then, of course, use that money elsewhere, however you see fit, for not only businesses but also traders and investors as well. So that's the main reason why is as to why we've seen the dollar yen continue to see the biggest reaction. And usually it does have a lot of volatility itself in general as well. But then you can see that the second biggest reaction was the euro dollar. And then if you flip over, you go to the Aussie side and you go to the Kiwis, you can see that there was quite a decent reaction from them as well, from the initial market reaction. Then if we're looking at the bonds as well, also one thing I do want to cover today is Bitcoin. I want to see how big that reaction is going to be. I have started doing that more so with the other economic releases. I believe I did with the CPI data as well. But usually if somebody's question in the chat is going to be, how is Bitcoin going to react? Well, if the dollar goes up or if the dollar strengthens, usually what happens is that the risky assets like the stock indexes and also gold too, Bitcoin will go down. So there is that inverse correlation that is present there with the dollar, gold and Bitcoin and the stock indexes that we've got to be aware of. So what are we got to be? So let's kind of summarize what we need to be aware of today. I'll go over it again. The key things we need to understand: if there is a 50 base point hike by the Federal Reserve, you'd expect and you can see in the past when the rates have been raised and the sentiment of course has kind of matched it. What happens is that the dollar would see a strong amount of appreciation or a strong bullish reaction. If the rate is higher than comes in higher than expected, stock indexes will take a bigger hit. But then you'd also be looking at the rate statement itself as well. Does that rate statement mitigate, or does it aid the strength of the dollar if it's, let's say, you get a higher than expected rate and a hawkish statement, okay? Or the other scenario is the Fed doesn't raise rates at all today. They just stand pat on where they are at 5.25%. If that happens today, of course, if the expectation is for them to raise rates and they don't raise rates, then you'd see a bullish reaction for the stock indexes and a bearish reaction for the dollar. Remember, traders have been pricing in this, of course, since the last meeting. So if we go in, if we go in the opposite direction where they don't hike rates today, instead they provide a statement as well that is hawkish, but not so hawkish enough to say that they're going to continue raising rates, then of course that's flipping the market on its head, basically, and the expectation on its head. And it might mean that traders might start pricing the expectation for a rate cut sooner rather than later. Okay, let's go to our markets here. So again, if you sign up to the MACROACE mailing list, you get the link for this free. Well, of course, need to. So again, completely free. And if you have found this information useful so far, don't forget to share it with your fellow friends and traders. Get the word out there. We've still got about 13 minutes left. What we're gonna be doing after the rate statement comes out is kind of go through a little bit of analysis to kind of to understand what has been said and what's new, what's different, what is a surprise or not a surprise, what's hawkish and dovish, and so on. So do stay tuned with us as well. Now, one of the other things to be aware of whilst we're waiting for the data to come through is with FinancialJuice. So FinancialJuice, a live voice and text service. Okay, what it does, it provides you with real-time news of what's going on in the markets, why it's happening in the markets, paired with economic data calendar, or with the economic data calendar on the left hand side here too. So here you have your news feed of text headlines. In this little box, which you can see here, which is the voice or the news feed or voice feed for the FinancialJuice service. And again, what we're doing here is particularly for aimed at day traders, is giving you up-to-date real-time information about what's going on within the global macro environment and what are the markets doing and why there is, and if there is a reason to them move within the markets. Usually with the fundamental news drives the markets, and then of course you have the technicals paired with it that also drives markets too. So there's two things to be, of course, as a trader, to be aware of. But as a day trader, if we think about the big boys and what they do, they have access to a live voice and text service. The reason why they do that is because, one, they're able to capitalize on potential trades that appear to them or could appear to them. Secondly, manage their risk as well when they're during the day. So if there is a bit of negative news that's come out for the markets, maybe Fed's Powell has said, I am going to raise rates by 75 basis points, baby. If he says that in the FOMC press conference, that would surprise the markets. Then, again, that's of course something we would definitely report on and probably try and copy his voice, because he's not like that. He's like a personality. He's got a dead fish kind of personality. Anyway, I'm not gonna pick on him. He's been doing his job, so he's all good in my books so far. But if we carry on then, so that is FinancialJuice, and what we can do is we do have a 7-day free trial of FinancialJuice and the new service in the Pro version. So again, the Pro version, and there is a light version. The light version has adverts playing. There is a delay to the feed or to the news feed overall, but it still can be quite useful. But when you are day trading, you want to be able to capitalize on those bits of news as quickly as you can. So having a real-time voice and text service is more beneficial to add to Arsenal. Now, I'm not saying that you've definitely got to sign up for the Pro version of FinancialJuice. What I'm saying is, it just gives you that edge that you would need, that you can have beside you. If you've never come across a live voice and text service before, what you can do is, first of all, sign up to the FinancialJuice feed, FinancialJuice site, the feed, have an account, go to your email, verify it, come back, and then have a little play with it. Okay. and see what you think. If it kind of how does it work? How does it fit within your day trading? You know, if it doesn't, fine, that's perfectly fine. If it does, and let's say you want to go for the pro version of FinancialJuice, well, let's say you want to go for the pro version of FinancialJuice straight away. First, of course, make sure you have an account on FinancialJuice. We've had it in the past where people have kind of just gone straight to the pro version and not had an account, and then they've had account issues because they've kind of gone through a weird way, or they would not have been told which way to kind of go about signing up to the pro version. So if you do sign up to the pro version, there's a little button that will be here. It says Go Pro. Make sure you have an account first on the FinancialJuice newsfeed. Then, once you've done that, go to your email, verify your account, select your subscription that you want to select for your pro version. Then what you will need to do is log out of your FinancialJuice account and then log back in, and then that will act as a verification. You should be able to see what I'm seeing here. Of course, you can chop and change the color here, but you should be able to see here where it says FinancialJuice Pro. It doesn't say Go Pro anymore, and it says Pro here on the voice feed as well. Okay, so that is FinancialJuice. We're gonna be getting ready for the rate decision. We've got about 8 minutes left. One of the other things I need to get set up to is TICKSTRIKE. So what does TICKSTRIKE do? Hopefully you guys, maybe you guys have come across TICKSTRIKE in the past before, but if you haven't come across TICKSTRIKE, so what it allows you to do is to listen to order flow within the markets, not just within within currencies, but also within futures, stocks, ETFs and ETNs, and also your internals, and also crypto too. It also allows you to have a look at how strong, or if I put it in other words, how strong is the buying or selling momentum within that asset or assets. So if I just bring this up here, so these little boxes here that I've got are the ticker boxes that I have. Okay, let's get rid of that out of the way. Let's get gold. Let's put that. That's probably going to be, that'll fit right there. Actually, I'll move that. There we go. Put that right there. So these little boxes are the tickers. So this little plus symbol shows you the buying momentum, and of course the minus symbol will show you the selling momentum. Now, what am I doing here with this slider? This slider represents the sensitivity of the ticker. Okay, so level 1 is the most sensitive to market reactions, i.e., if there's a little bit of buying or selling that occurs within the asset that you're looking at, then TICKSTRIKE will pop off. So here, if there's a little bit of selling that's going on in gold, then TICKSTRIKE will kind of pop off there. Okay. Now, if you want to see, so if you kind of increase that number all the way to 15, of course, you can chop and change with this here. Level 15 is where there is the least amount of sensitivity, i.e., when there is only when there is a lot of buying or selling momentum that occurs, does TICKSTRIKE give you that visual and audio alert. I don't know if you guys won't be able to hear the sound on here, but I've got a little alert sound playing for me. So you can either look at it visually or listen to it, or do both. So whatever works for you. Okay. So again, TICKSTRIKE. So again, if you're day trading or scalping the markets, TICKSTRIKE is another tool to add to your arsenal as well. All right, so let me get the link out for you in the chat as well. Of course, we've got time, hence I'm going through it here now rather than afterwards. Again, don't forget to like the video, subscribe to the channel, get the word out there, brother, about MACROACE and what we're doing here. If you find the information useful, okay, don't just share it for the sake of it. Please. No, I kid. Only if you find the information useful, get the word out there and get people on board. So this is a link for TICKSTRIKE, which is a 7-day free trial. Have a little play with it. If you don't want to look at the trial, then of course you already have it on the site here, but in a limited version. Okay, so you're looking at the S&P, Euro, Dollar, Oil, and Bitcoin, and the sensitivity level is fixed, so you can't change that. But if you want to have a play with, or if you've never come across TICKSTRIKE before, then again it gives you another area to kind of play with TICKSTRIKE before you decide to pay for the full version of TICKSTRIKE, separate from the FinancialJuice bit here. Okay. All right. Let's see. Right, there we go. So, yes, we have less than 4 minutes. Less than 4 minutes now till we get the rate decision. So let me go through the expectation again. If the rate comes in as expected and there isn't a rate hike, you'd expect a bearish reaction from the dollar and a positive reaction from the S&P or the stock indexes and bond prices and also gold. If the rate statement that's paired with it is a hawkish rate statement, i.e. that the central bank still feels that they might need to raise rates in the future, or they still feel inflation is an issue for them, or maybe the economy is doing much better than they had expected, then it could mitigate how strong that initial strength or bullishness is within the stock market, and also the initial weakness for the dollar. If you get the rate hike as expected, it goes to 5.5% from 5.25%, then what you could expect is, and then the rate statement is, let's say, hawkish, or if let's say the rate statement doesn't present anything new, it's more or less the same of what we'd seen last time around, then the market reaction, you wouldn't see a clean direction, i.e. that you would see more of a whipsaw reaction from the market instead. So that's one thing to just be aware of with when we do get the rate decision. Let's say the rate comes. Let's say the rate again comes in as expected, but the statement is hawkish. Then you could see a potential strength from the dollar, weakness from the stock indexes. If you get a dovish statement instead, where they say that inflation is declining and that the economy may be is seeing some weakness in areas, then that's something. Then again, what that could mean is that that there is more weakness of the dollar, and the S&P starts to see a positive bit of momentum instead. Let me get a Bitcoin too, because I do want to get that too. Let's get that here. Right, let's get the futures. All right, let's go. Okay, let's see here. We've got 1 minute left. Let me put on gold. Base case, I think if you'd get a mix, I think you'd still get the expectation. I think the rate would come in as expected. Don't take this as advice. If you do, I swear to the Lord Jesus Christ himself. Rate to come in as expected, and then for I think there would be a bit of a repeat of the last rate statement that we had seen. So they're expecting to maybe continue to keep an eye on the rate, but the only hawkish bit to expect another rate hike at the next potentially for the next meeting, although explicitly not saying that. Okay, we have about 10 seconds to go. Let's see what this baby does. Okay, hike, 25 basis point hike, 25 basis point hike as expected to 5.5%. Seeing the dollar yen move towards the upside, the S&P go down. Gold did see that initial move down, and now there's a flip. So let's go to the comments here. They will continue reducing his bond holdings. Let's kind of go from it. Also, the CBOE have provided their economic outlook too. System sound resilient. They will continue to assess additional information and its implication for policy. Inflation remains elevated. A policy setting committee remains highly attentive to inflation risks. They'll continue. I've already said that. They're strongly committed to returning to inflation to its 2% objective. Banking system is sound and resilient. else we got here? What else? Okay, let's go through what the CBOE have said too. So they project core inflation or core PCE to be at 4.1% compared to 3.4%. Growth forecast to 1.5% from 2.5% in February for 2024. So CBOE cutting the 2024 US GDP growth. 2025 growth forecast cut to 2.4% from 2.6%. Second half US GDP growth slowed to 0.4% annual rate after 1.4% growth. Yeah, so not really. It's okay. So nothing surprising there. You got a bit of a. You didn't get any mention of. I'm just trying to just make sure what I've got here. You didn't get any mention of another rate hike. Not that we can see. Not that I can see there. So yeah, so there's a bit of a whipsaw reaction on the dollar yen, and also on the S&P initially on the initial candle. Gold said a bit of a drop down, and then a move towards it back up to the upside. Bitcoin, well, Bitcoin be Bitcoining. Yeah. Okay, so let's kind of go through some of the others. So let's go through some of the market reactions here. Let's see what do we get. Don't forget, of course, to like the video, subscribe to the channel, and get the word out there. What I'm going to do is I'm going to measure the initial market reaction that we had seen from when the rate decision had come out. Okay, and then so there's going to be, we're going to see there's going to be two market reactions that I'm going to kind of keep an eye on here. So go there. Okay, so that was the initial pop to the upside, about 12.5 pips, and then it ended down here about 17 pips or 17.5 pips. Okay, that was on the dollar yen, so nothing surprising. It was more or less, yeah. US interest rate, here we go. US interest rate futures put chance of Fed hike at 18% in September and 36.5% in November, after 36.5% in November after the statement. So i.e., probably expecting this to be the last one. Right, let's have a look here. Okay, so the S&P through, whoops. Yeah, so when we're talking about Fed's Powell, I did see the question in the comments. Usually, there aren't any further surprises that come through from Powell, because it's already been delivered in the statement, or let's say the SEP projections. You don't really see anything new from him. It is more of a repeat. He might provide some hawkish commentary about where they see inflation. Again, like let's bring that here. Let's see what we could talk about. That's another point to be aware of too. The recent indicators suggest economic activity has been expanding at a moderate pace versus modest pace in the June statement. Yeah, inflation, again, sort of repeat what they said before. I mean, we could get a repeat of some of the language from Powell, maybe. In the future, sorry, not in the future, in the rate statement for himself. But usually you don't really see, you usually see profit taking that occurs through Powell's commentary. You don't really see anything that kind of surprises the markets that often, really. Okay, so about 20 ticks up to where the candle ended, or to the wick of the candle. Gold about 50 ticks down, and then about 34 ticks. Oh, let's get rid of it. Okay, let's see. What have we got? What you got? What you got, baby boy? Okay. Still too much there. Still had a positive reaction though. So Gold already done. Bond prices I want to do. Let's go to the 2-year. Okay. 2 bond price. I'm going to presume that was. I'll look at it in the replay later on. But I presume that there was a bit of a tick, a wick down, and then, well, like the rest of the market, and then we went back up. Okay, so that's 17 ticks. So what does this show us? Yeah, boring day, no blood, no money. Yeah, the rate was as expected. Bricktop, weren't you watching the rate? But yeah, it was a 25 base point hike as expected to 5.5%. No surprises there. All right, but yeah, so let's get some feedback now. I think it'll be quite good. What do you guys think of the live stream, or the live streams that I've been doing? Have you enjoyed? I did ask before, but I want to know kind of now, after seeing how the FOMC has come out, whether that's kind of changed your view, whether that's added to your view that we've seen so far has been good, useful, not useful as you might have expected it to be. Yeah, give me your thoughts too, and also on the MACROACE emails that I provide out on every Monday morning. If you're not seeing those emails, double check your junk mail if it has appeared in there. Again, if it has appeared in there, like I said, it's a little short summary of what to expect for the week ahead. The links to the live streams, and of course a link to the ranges and deviation sheet as well. But yeah, so I would like to know, I'll kind of give you guys a bit of time, of course, you're maybe trading. And it says, where can I subscribe for these emails? So yeah, here you go. So I'll provide the link again. Here we go. That is there. Bearing in mind, so the emails, they're not huge, big emails with charts and graphs, although I actually did it for the last one with, actually this one for this week. I did one chart of the euro after the PMI data, or a summary of what, or to show you the reaction of what the PMI data was like. But yeah, what am I missing? What if you've used it in the past before, and then you've unsubscribed from the mailing list? What's caused you to do that? And let's be honest with the service itself. What's not working? What can we do to build the relationship to keep you guys interested in the information? Shivaraj said, "I like them very much. Helps to clear my mind, get a perspective, and focus on the markets." Rowdy Roddy Piper says, "Thanks for hosting. Was appreciated." Mr. Bulwark says, "Great to get your perspective. Highly appreciated. Even though I don't base trades on it, of course, yeah. If yeah, I can say, or of course, you should know it's not financial advice. It's just a historical representation of what's happened, and you decide to do whatever you want to do with it." Joe says, "It's great watching the streams grow since you started to do them." When did you start watching them? I just want to kind of maybe you have been watching them, just haven't commented, like just watching them in general. But yeah, that's great if you've been with us for quite a while. Thank you very much. NS says, "It's your second time watching the stream, but you find it really valuable to hear perspective on these matters." Mohammed Ghazan says, "I love your streams and appreciate the insight." Thank you very much. So tell me what's not working, because you guys are giving me positive feedback here. What's not working? The whole point is to give me constructive feedback. Yeah, what's there's got to be a reason as to, there's something that's missing. Let's go to the finite details. What am I missing? What are we not doing? What's not working well? I like praises, that's great, but I also like to hear the good and the bad, at both sides. Otherwise, you're gonna inflate my ego. Hard not to be positive here. Okay, Benjamin. There's got to be something. Come on. Why? One improvement. Okay, here we go. Joe says one improvement I would recommend with the deviation sheet is the lack of a chart. Okay, so you want. Okay, so actually, that is something that one of our analysts, James, is working on a chart of reactions of the different economic releases. We're kind of building that up at the moment. So in deviations chart or in the deviation sheet, actually that could be a good idea. Okay, all right. But what? Let's say like a box plot chart per asset categorized by the event. Yeah, okay, that we can definitely do. As said, James is working on that, and he has got some stuff together for CPI. Don't know about the FMC, but yeah, it's kind of a work in progress on that. Okay, but yes, we can add that. But yeah, so let's talk about you subscribe to the mailing list. Why have you subscribed to the mailing list in the first place? 2, then why have you unsubscribed from the mailing list? that's what I want to get. What are we missing in the emails? Is it because there, there's not enough information? Or yeah, let me know what's missing. Maybe a bit of info on the upcoming events. Okay, take your point there, Benjamin. So yeah, so how it kind of works is there is a little bit of information because in the live streams, and I've always said this is where I provide the information and go into detail about the in the deviations sheet. Maybe a bit of info on upcoming events in the deviation sheet. Okay, that I can think of. I can think of how to I'll have a little think about that. But yeah, the live stream is where I kind of go into detail, like I'm doing now with you guys for the FMC. I'm going through the live stream here. Give you guys details about the rates decision. What else? Let's bring up the NQ while we're kind of doing like a Q&A session, I guess, here now. Actually, let me get up the video of tomorrow's live stream for the ECB rate decision, where they're expected to hike their rates by 25 basis points each for the deposit and the refinancing rate. Okay, that is there. That is the live link for tomorrow. Mr. Bulwark says, use an FJ on a daily basis, see the times of essential reports, not using the pro version though. Earlier used to include the links to most Fed Speaks events, watching the charts, not constructive. I'm confused. Yeah, it's I don't think in the live streams I would include events to the FMC press conference report. I've never done that. It is on the feed anyway. It should be on the feed, regardless of whether you're pro or light. On the FinancialJuice feed, it's good to see they're using it on a daily basis though. That's good. Watching the charts is not constructive. That point I don't. I'm not sure you mean by watching the charts is not constructive. Clarify that for me. I got the rest. Unless you can see what the boys are doing in the office. That's a different question. They're just watching the charts and not the news. As that's and not providing the news. Okay, typing limit, but can't really expand on it much. I'm watching the charts, so can't be constructive. Oh, right. Okay, so you mean now. Okay, all right. Okay. Fair enough. Fair enough. I'll tell you what then. Let me do this. I'll provide my email for peeps. Of course, if you want to, do go back to trading, that's perfectly fine. I'm not going to hold you hostage. But yeah, that's my email there for Financial Juice to give me your feedback as well. And it says 1 point of feedback for me would be the design of Financial Juice website. So what I'm looking for is feedback on MACROACE. What I'm doing here now, doing the live streams with you guys and the mailing list. That's what I want a little review on. But the email is there as well. So Wall Street Jingle says, this is great. I can watch my own stuff and to listen to you to make sure I'm using my ears. Keep it up. Thank you. All right. I think what we'll do then, you guys probably don't want to keep hearing my voice in the background. Well, you can close the video. But yeah, so what I've done is provide an email so you guys can email me about any feedback that you have. Van Ripper says, so you guys are including stock earnings, which is great. Will you guys consider adding commodities data such as wheat, corn, soybean? I trade commodity futures. That's why I'm inquiring. I think we did have it before. We did have wheat, soybean, and beef there before. Of course, we've got EIA crude oil inventories. That's always there every week. As you can see here. But I think the demand for the other commodities, when we asked our audience, it wasn't there. They didn't really care about that much, being honest. Of course, for yourself, yes, you're going to care about it. That's where you mostly trade. But for our audience, we ran with it for I think about a year or so, kind of going backwards and forwards with customers and seeing what they kind of prefer, what they don't prefer. But it's something that we can reconsider again. But again, it's kind of got to make sure that everyone wants it, wants that data too. But yes, right. Take care. I will see you guys tomorrow at 7:45 a.m. Eastern Time for the ECB rate decision. Similar to the Fed rate decision, there isn't that much pressure, but it doesn't mean that the market reaction isn't going to be that much smaller for the euro. All right, thank you very much, guys. Have a lovely evening, and I will see you guys later. Question from Benjamin says, do you analyze the FOMC statement and describe it a bit easier for those who struggle to understand? Yes, I do with I do with the same way that come through. But yeah, but again, ask me. You can email me, and I'll see you guys next time. Sayonara.